In this video, you are going to learn about how to read an option chain. That includes calls and puts and other things like Greeks and open interest. Let's take a look at an example. First, you're going to see a bunch of dates. Those are the expiration dates for each contract. Let's take a look at calls and puts for January 14 expiration. You get calls if you think the underlying is going to go up, and puts if you think it's going to go down. In the middle, we have the EXP for expiration and strike for strike price. On the right, we have the bid and ask for calls, and on the left, we have the bid and ask for puts. Now, this platform is TD Ameritrade's Thinkorswim. You may use other platforms that might have the setup slightly different, but the setup isn't going to be too different. If you want an Apple call with 175 strike expiring January 14th, you will be paying between these prices for a premium per share for 100 shares. So whatever price it's showing times 100. You will notice the percentage on the top right of each expiration. Those are your implied volatilities. And yes, they are different for each expiration. So what do they mean? Well, we need to look at our option Greeks. And if you don't know what those are yet, check out our short but detailed video links down below in the description. Alright, back to our option chain. We see our delta, gamma, theta, and vega. And remember, this is for Thinkorswim. Another platform may have different display setups. So same Apple call, 175 strike expiring January 14th, you have delta of 44 cents. That means, with a $1 move from the current price, the option premium will go up or down 44 cents. If Apple goes up to 173.26, your contract will go up by 44 cents. And if Apple goes up to 174.26, your contract will go up again by your new delta, which is 44 cents plus your gamma, which is 2 cents. So up another 46 cents. Just to clarify, if you get the contract now and Apple goes up by $2, your contract will be up 44 cents plus 46 cents, which is 90 cents per share. Same thing for puts. If you think Apple is going to go down and you get a 170 strike put now, if Apple goes down to 171.26, your puts will gain 45 cents. If Apple goes down $2, you add 45 cents twice, plus gamma to the premium. Then we have theta, which is straightforward. For your 175 call, your premium will lose 12 cents after today. And for you 170 puts, your premium will lose 11 cents after today. The last Greek showing is vega. Now this is related to the percentages on the top right, which are the implied volatilities. If your IV goes up by 1%, you add vega to your premium. If IV goes down by 1%, you subtract vega from your premium. For your 175 call, if the IV goes up to 38.56%, your premium will be 19 cents more. For your 170 put, if the IV goes down to 37.56%, your premium will be 19 cents less. Let's take a look at strike prices. Strike prices are the price points at which the contracts are exercised. Could be bought for calls or sold for puts. Let's say if I'm holding an Apple call at 160 strike, I can exercise my call and buy 100 shares at $160 each. I can then sell the shares at market, pocketing the difference in strike at market. Many stocks have increments of $1 or more. Those stocks or ETFs that have more liquidity, you can see strike increments of 50 cents. The smaller the increment, the more liquidity the underlying has, such as SPY.